Welcome back to the Swipe Savvy podcast. Today, I'm joined by my co-host and co-founder of CreditVerse, Alian. What are we talking about today?
Today is all about credit scores. We're going to first try to understand what a credit score really is, what are the factors that make up your credit score, and a couple of tips to improve upon it. So with that, I think we can just get started.
All right. Well, what is a credit score?
So a credit score is just a numerical representation of your credit worthiness to a bank or another lender. So it's like in 3 digits, anywhere from I think like 300 to 900 in Canada. And there's a couple of different factors that make up this credit score, and I'll have different percentages. So do you want to walk us through a couple of those?
Sure. So I think the biggest one is payment history, and that makes up 35% of your credit score. So payment history simply means, do you have a history of paying your credit card bills on time? And keep in mind, this isn't just limited to credit cards. This is all kind of credit or outstanding money that you owe. So do you have a history of paying it on time, paying it in full? And I think that pretty much sums up payment history. Anything to add?
No, not really. I think the only thing that you could really add there is that you just want to make sure your bills are paid on time all the time, because it's a really easy way to very easily raise your credit score. It's the largest percentage of your credit score. So as long as even if you make the minimum payment, you're still technically making the payment. So in the worst case scenarios, we just recommend doing that. But ideally, we're not really going to get to that point. And I think maybe in this podcast or another podcast, we'll break down some of the ways you can pay off some of your debt effectively if that's something that, you're struggling with right now.
Yeah, for sure. So let's give a quick example of what that would look like. Somebody with a good payment history score versus somebody with a bad payment history score. So a good example would be somebody who's owned a credit card for maybe 2 years now, and every single month they pay that bill before the due date. Not after the due date, not on the due date, but before the due date, just because you don't want to run the risk of, processing times. Somebody 2 years consistently paying their bill on time, because as we know, one red mark on your account, one missed payment, and it's a huge, huge hit.
Yeah, it's a pretty damaging factor as well, because it's really easy to miss one payment, especially if you're someone like me who has, so many different credit cards, other credit products, lines of credit that they need to pay off all the time. It is easy to miss one of those due dates. Just, I forgot that I had a balance outstanding on this card because I used it this month, but I didn't use it for the last 6 months, for example. So I think a good way that I kind of keep track of that is I have an Excel spreadsheet that I've linked to a Google Calendar, and it just gives me you have a payment due in 3 days, just reminder, pay this now. And then I try to do it maybe every Sunday, or I have a time set up every once a week. I just make sure I pay everything that was outstanding that week, whether it be the credit card, the line of credit, even things like the hydro bill, for example. All those things do contribute to their credit score. I think other bill payments, for example, your cell phone as well, does play a part in that as well. So just make sure you try to keep on top of that. And I think being organized is really just the key to all of the stuff about how to get a good credit score. It's just be organized, be very disciplined, and just be consistent.
Yeah, I think the way I approach it, instead of that weekly approach, I do more of whenever the bill comes in, I just pay it. Just want to get rid of it, don't want to have it outstanding. And this shouldn't be a problem, especially if you treat your credit card like a debit card. Don't spend money you don't have, and you won't have any issues paying that off. So what's the second component?
The second component I can think about would be credit utilization. So this is a percentage of your total credit limit that you use up every single month. This, I think, generally ends up being things like revolving credit, so a credit card. And I think a good example of utilization percentages would be if you have a $1,000 credit limit and you have a $300 bill on your credit card at the end of the month. So the outstanding bill is $300 when you get that payment. You have 30% utilization. And I think a good metric we try to use is keep it under 30%. Obviously, anywhere from 1 to 10% is the ideal. But honestly, if you keep it under 30% consistently all the time, which shouldn't be a problem once you end up, getting a few more credit cards, or your credit limit keeps getting increased, just keep it under 30%. It won't drop the score at all. If you really want to raise your score quickly, I think one thing I did is that I kept it at 2%, because of what I used to do is just pay off all but 2% of my outstanding bill before the statement date. So before the day my final bill gets calculated for that month on my credit card. And then I got these ridiculously low utilizations, and I was able to get a very high credit score very quickly. But honestly, I don't think you really need to game that at all. I think you did something very different where you just paid off your bill when it came in. and you had almost the same score as I did at that point in time. So it does help a little bit, but really at the end of the day, if you're playing the long game, they end up being pretty close to the same.
Yeah, it's important to note that this is worth 30% of your score. So payment history 35, credit utilization 30. So still a massive, massive chunk of your score. So something to definitely keep an eye on. And I think there's two kind of ideologies and two ways people approach this. The first way is kind of how you did it and try and keep that very, 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 very low credit utilization. But what people run into, and the issue that oftentimes people run into, is they have a credit card, they're a student, and their credit limit is $1,000. It's their first credit card, that's all they have. And eventually, as you grow up, as you start having more expenses, you're going to run that limit up, and you're going to run your utilization up naturally, and that's going to affect your credit score. It's important to, before jumping out and either increasing your credit limit or getting a new credit card, to really take your time with that, because while it does damage your score a little bit, the damage of applying for a random credit card or applying for a credit limit increase too early can be more detrimental in the future and have more repercussions. So really figure out what suits you best in terms of increasing your credit limit, finding a credit card that maybe will benefit you more in the future that you'll actually use. But I think that's something that goes hand in hand with credit utilization. And when people see a 70% utilization, they often jump to conclusions. But I think we have a video talking about that as well on our YouTube channel, where we go more in depth on what to do when you run into those situations. Anything to add on that?
Honestly, again, no, I think you covered the points really well. I think one thing where you mentioned getting another credit card or increasing your credit limit will have more detrimental impacts. That's not necessarily from the credit hit you take. And at least that's the way I interpret it. It would be more from the fact that if you have a larger credit limit, you're maybe more inclined to spend outside of your means, and you won't be able to either keep up with those payments, or you'd forget to make a payment on that other card, or whatever the case may be. I think, as Elio said, taking your time with it and just starting slow, because there's no real point to try to get ahead as quickly as you can. Because we're also going to talk about how important credit scores are and what they really impact in a couple of minutes. But just start slow. When you're young, if you're starting when you're 18, you should have no problem by the time you're really making some of those big life decisions where you would need a credit score. I don't think you'd have any problems having an absolutely excellent one if you just make sure you make your payments on time and you don't get the utilization too high. Yeah.
All right. Third component is the length of your credit history. So essentially what this means is how long have you been accumulating a credit history for. So this would be for most people when they apply for their first credit card, at least in Canada, because you can only start building at 18, I believe.
Yeah, I believe so. Another way would maybe be through student loans, but again, the time difference between you getting a student loan and a credit card, probably a couple of months, if that. So
yeah, and this accounts for 15% of your total credit score. So let's build on this. What is the importance of this? How do we tackle this?
So the importance of this is just, try to keep your average length of credit high. If you have a bunch of accounts that, maybe you don't use as much, for example, you have a credit card that you don't really use that much, instead of canceling the card outright, which in a few years will slightly damage your credit score, shouldn't be too bad. Again, this is only 15% overall. Maybe transfer that card to a card with no annual fee that you just hold on to, use once or twice a year just to make sure it stays active. And then just keep it going and maybe upgrade it later on, or whatever the case may be. In terms of how to tackle this, just don't apply for a bunch of random stuff, because that would lower the average age of your credit. It doesn't make a huge difference, to be perfectly honest, but every little bit does count a little, I'd say. And there's no real way to game this either. There's no way to make your average age of credit any higher. You're really just limited by when your oldest account was, how often you're picking up new accounts. And yeah, I think, is there anything you want out there?
I think maybe don't be so quick to close a credit card that you're not using, because that will decrease your age. Mm-hmm. And that is one thing that you can control. There's a lot of things you can't control in this factor, but that is one thing you can control. So maybe if you're really trying to keep that high, which again, it does have an impact, but the impact is a lot less than some of the previous factors that we mentioned. But that's the only really thing that I'd mention there.
Yeah. Speaking of having an impact, I think the next part of your credit score is something you have the most control over, I would say, maybe more than even the amount you pay your card. And it would be the new inquiries or the hard inquiries on your credit. So every time you apply for a new credit card or another credit product, maybe a car loan, maybe a mortgage, you do get a hard check on your credit. And every hard check does decrease your score a little bit. In certain cases, when you're just building up your credit score, you're going to see some pretty wild changes. I think I saw a 30 or 35 point change at some point when I applied for a card. But that does go away after about a month or two. You go back to normal. But again, this is worth 10%, I believe. Not a huge part. I think if you go on any of the credit monitoring apps, it's going to say oh, this needs work if you have more than 2 or 3. I think getting 2 credit inquiries a year, it's pretty hard to get underneath that because you get a new phone plan, for example, you're going to get a credit hit on that. You get any new credit product, you're going to get a credit hit on that. So I wouldn't worry too much about this, to be honest. Again, don't apply for a bunch of cards you don't really need to increase your credit score or whatever, which I think we're going to, again, talk about in a couple of minutes. But don't stress too much if you even have 7 or 8 or 9 or 10 over 2 years, because it doesn't play that big of a role and the effect goes away pretty quickly. But yeah, anything you want to add there?
Yeah, I think while it doesn't play a big role, it's important not to go overboard. And again, like I touched on for credit utilization, it's not just because it can decrease your credit score. It's because it can have other effects, side effects of applying for a million different credit cards. You don't want to be liable for all that debt, all that responsibility. But yeah, that's worth 10%. I think you mentioned that new inquiries, pretty simple. And there's one more factor that goes into calculating your credit score, and it's also worth 10%, and it's called your credit mix. You want to explain that?
Yeah, so your credit mix is pretty much just how many different types of accounts do you have. So a credit score would be one, that'd be a revolving credit line, I would say. Then another thing would be maybe a phone bill, that would be another separate type of credit. There'd be a car loan, a mortgage. Those are all different things. This is only, again, worth 10%. So don't chase it. Don't apply for new stuff. I think we've gotten some advice in the past that, just apply for a car loan so you'll increase your credit score. Don't do that. I think that's a pretty bad piece of advice. This is something you should build up very naturally. I think I only have 3 different kinds of credit on my report, and my score is pretty fantastic. I think you're kind of in the same boat there. So this is something that definitely at the very, very bottom of should be chasing. This is not there at all. Don't apply for anything you don't need. Especially because, again, only 10% doesn't make a noticeable impact on mine. Maybe my credit score would be a couple of points higher, but this isn't the race to 900. And I think we can lead into kind of that topic where, unlike in the US, credit scores in Canada are really pass or fail. If you're over a 680, you pretty much get the best interest rate on everything. There's no point to really go, for 700, 750, 800. I think one of our profs last year was talking about his 800 credit score and how it made absolutely no difference. And I think this really rings true. In Canada, I think we hear a lot about US personal finance. So it does cloud our judgment a little bit. And there's a lot of things that are a little bit different, while many things remain the same. And this is one of those things that, your credit score does make a difference past 680, realistically speaking. Yes, it may be a little bit more challenging to get approved for certain cards, I would say, if you have a 680 versus a 700. But again, past then, there's no change at all. I think my credit score is 750 or 760, and I haven't thought about increasing it anytime in the past. So yeah, definitely do not chase that. I think this is it's a fun conversation with our friends as well. I don't know if you've ever had this, oh, what's your credit score? And your friends have a higher credit score than you. They're oh, you're the credit card guy. You should have the highest credit score. It doesn't really matter. And I'm not just saying that because I don't have the highest credit score of my friends, for the record. There's actually no difference whatsoever I've seen. I don't know if you noticed any difference on your end, but...
No, I think, yeah, once you've passed that threshold, and I think the other key point here is that if you use credit responsibly, in a responsible manner, you don't try and play any games to increase your credit score, you're going to be well over that threshold without any problems, as long as you're not in any serious financial distress. So, yeah, the key takeaway here from all these factors and everything we pretty much told you is you can pretty much ignore that as long as you're responsible with your credit, responsible with your money. And then you don't have to worry about any of these factors because you'll be fine. You'll pass that threshold. You should be able to get a mortgage. You should be able to get a car loan, which maybe not a great idea, but...
So we had a couple of technical problems, and we had to cut the podcast, in half. But I think to kick us back off, I'm just going to pose the question: how do we actually check our credit score? We've talked a lot about what it is, what it represents, but how do you really get to it?
Yeah, I think there's a few different ways to do that. The most common and easiest ways are by using by using your own bank's portals, other apps or websites. I know CIBC and RBC both have features where you can go in and kind of check your credit score. And the more common ones that we're seeing more widely are things like Credit Karma and Borrowell, which allow you to just input a few personal details, and it gives you not only your credit score, but some insights to go along with it.
Yeah, so those are the two like really mainstream ways. Another way to do it is something that became law a few years ago, where the two major credit bureaus, TransUnion and Equifax, have to give you one free detailed credit report every year. So the way you access this is just by going to their site. Make sure it's actually their site because you're putting in your social insurance number, so you want to be like 100% certain you're not getting frauded, because it's a very, very easy way to get frauded. But just go in there, put in your social insurance number, some other additional information they're going to need to verify if it's actually you. And then you're just going to get a very, very detailed breakdown of your credit, like a credit report, basically. It'll tell you where your score is, what all the factors that contribute to it are, how much percent, for example, utilization you're using, what all of your accounts are. But I think most importantly, it actually tells you a lot of the personal information associated with your credit profile. And it's a really good way to check for a lot of those errors. So it's very unfortunate, but getting errors on your credit report is like a very common thing in all of North America, actually. And it's a really easy way to just mess up your credit score without really even knowing, because you can have a flawless like payment history and everything. But for example, someone has defrauded your identity, and they're now like taking out on accounts. You won't really know that until you check your credit score or your like credit report actually. Or another like case would be like, someone has a very similar name to you, and the two accounts got kind of messed up. Maybe they didn't put their SIN number in when applying for a card, or whatever the case may be. Mistakes do happen at a much higher rate than we'd want them to. And I think one way to just make sure nothing is really going on is just being proactive and like checking it every so often. Once a year should honestly be fine for that like total report. You don't really need to pay for it. And you don't have to pay for the credit monitoring either, unless you've gotten if you've gotten frauded recently, then maybe that's something you want to consider. But in most cases, just check it once a year, like the credit report itself. Maybe check the other one every 2 or 3 months. I don't know how often you check yours.
Yeah, I mean, Credit Karma, Borrowell, I log in maybe once every 2 months. Just keep an eye on it, see if there's any major changes, then I know something's wrong. Mm-hmm. But otherwise, I think the key point that we're kind of trying to emphasize here is that, yes, these factors are important and it's important to understand them, but using your credit card and just being financially responsible should leave you with a decent score.
Yeah, absolutely. I think if there's one like key takeaway for this entire episode, it would just be like pay your credit card bill. It's very, very challenging to get a bad credit score if you pay your bill off every single month, because it basically implies that you're using credit relatively responsibly. You're paying it off at least. Even if you have high utilization, that in the long run it doesn't make a huge difference. Just again, be consistent, and I think you're going to get a credit score that's more than good enough to get you anything within the first couple of months.
Yeah, I think we touched on this a little earlier, but once you've hit that certain threshold, 680 I think is a good marker. You're pretty much set for any credit product that you need going forward, like a mortgage, a loan, pretty much any basic credit card. And I think later on we'll dive into what a higher credit score gives you. But for the average person, for majority of people, it's not worth chasing a higher score. We're kind of into credit cards and we don't chase that higher score. Like if you're financially responsible, you use your credit card responsibly and you pay it on time, key point there, you'll easily end up at much higher than 680, probably closer to 750 without even doing anything. So I think that's the key point here. And if you take away one thing from this episode, just be responsible and you won't have to worry about any of the things that we talked about.
Yeah, absolutely. And I think that being said, you brought up, some of the things that a higher credit score may get you. And I think this is where we tie in one of the main tools we have on our CreditVerse .ca site called StackUp, which I guess in simple terms is just like an aggregator of a bunch of credit score and income application data for credit cards. And you basically just see it on a scatter plot. Just all the applications that were approved or denied. The green ones were ones that were approved. The red ones were ones that were denied. And you kind of see your line of best fit, and you can compare your credit score and your income to some of these cards. Now, again, as we mentioned, for the vast majority of cards, your credit score won't be the limiting factor. It would generally be the income, where you need like over $80,000 or over $100,000 of personal income to get one of these cards. That being said, there are a couple of like credit card products that require you to have more than a 680, or I guess they don't technically require you to have it because they don't say it on their site. But in our research, we have found out that there are certain cards that you won't really get approved if you're below like a 700, for example. But in our, in our research as well, there's been no case where you need like a 750 to get approved for a card. It's always like under 700, maybe like 710, if anything, for some of those super premium cards, or something that's like super, super obscure. There's certainly no card that needs like an 800 at all. And I think that's a pretty like impossible bar to really strive for as well. If you really think about it, like you could probably get to 800, but I think the amount of effort and time you take to optimize your like credit score to get to 800, you could do pretty much anything else with, and probably get a lot more value to your life than you would, because there's, again, like zero additional value you get for going from a 750 to an 800. And it would take you years potentially, but like, again,
Could get a better interest rate on something, on your mortgage maybe.
by like what? Like 0.01%?
Pretty much negligible. And I think where StackUp comes into play is if you're on that verge of maybe 680 to 710, if you're in that range and you're not 100% sure you're going to get approved for a card, you don't want to run the risk of applying for it, getting a hard check, and decreasing your credit score even further, and then getting denied for that card. So then maybe you really want that card and you have to wait another 6 months to a year to build back up, recover from that hit, and then try again. So it's a good way to just check in and kind of double check and make sure that you're all good before going through that process.
Yeah, pretty much. I think at the end of the day, like we've mentioned this for the last half of this podcast, it's really not that deep. Like pay your card. You'll like pay your card responsibly every single month. Don't spend money you don't have. And I think you'll be like fine. I think the more interesting thing to really worry about doesn't really even regard your credit score. It's more like the interest payments you'd be doing. If like you're only hitting the minimum payment on a credit card, like, yes, sure, your credit score might be fine, but other aspects of your financial life will suffer. And I think for most people, the limiting factor ends up, if you're being responsible, ends up being like them not having, them paying off interest or whatever the case may be, or them having like not enough income to get a credit card, or not enough income to be approved for like a mortgage or whatever the case may be. It's rarely ever the credit score, because if you start strong and start responsible, very, very slow steps, like baby steps all the way up the ladder, you're going to be perfect every single time. But I do also think it's super important to actually learn how all this works. Like when I was growing up, I didn't know how this worked. Even like maybe 3 or 4 years ago, I didn't really know exactly what went into a credit score, how much this really mattered. Because living in Canada, I think we got a lot of US information. I don't know if that was in the previous cut of this podcast, but we get so much US stuff, and a lot of it is the same. But one thing that isn't is the fact that credit scores are really just pass-fail here.
Yeah. And kind of summing it all up, as long as you're responsible, the factors specifically don't matter, but what they do is give you good practice in terms of managing your credit responsibly, and that will help in the future in terms of avoiding things like those big interest payments or debt, which don't like. Other than that, I think before we wrap this up, we'll kind of sneak preview into the next episode, where this one is a little bit more boring. Credit scores, not exciting, but definitely important to know. Next up, not as important to know, but a lot more exciting, credit card rewards.
Yeah, this is what I'm really, really looking forward to be honest. I'm a bit of a fiend. I think we're both a bit of a fiend towards credit card rewards. And I think that's what we focus a lot of our attention on with CreditVerse itself. When we're talking about new cards, it's usually like, oh, how many points are in the welcome bonus, or what can you do with these points? So I think in that podcast, we're really going to talk about, how do you really get started in like using rewards, whether it be like miles and points for travel, or it being like for other things like merchandise or whatever the case may be. And I think it's just going to be a fun little like 30-minute chat about how we both got started, some of the cool things we've gotten with our credit card points, and I think what we see the future really looking like for us, and how it's, I don't know, for me, I think points have really changed my life. I think that's a pretty like bold statement to make, but I think it's gonna be a fun little chat, and we're really looking forward to that.
Yeah, sounds like it'll be exciting. So, other than that, thank you for tuning in. If you're watching on YouTube, feel free to let us know any more episodes that you'd like to see. Trying to bring in some guests soon, so any suggestions there, anything that you want to see, we're always open to feedback. That's what this whole podcast is about being able to connect with you guys more, having more conversation like videos or podcasts, I guess, where we discuss the same topics but just in a different way. And yeah, subscribe, download our podcast, whatever works for you. And we'll see you in a month.
Sounds good. Take care, guys.